Are you looking to invest in gold and silver? Well, we have some potential exciting news for you. In this video, we will be discussing the potential price movement of gold, with predictions suggesting it could reach an astonishing $30,000 in just a few weeks. We have the privilege of hearing from Rafi Farber. Rafi is not only an investor but also an author and a proponent of the Austrian Business Cycle. His unique approach to investing includes focusing on gold and silver. In this video, he will be sharing his insights and predictions about the future prices of these precious metals. So get ready to learn how you can potentially benefit from this incredible opportunity in the market. Let's dive right into it. In his insightful analysis, Rafi Farber delves into the historical context of inflation, shedding light on a pivotal moment in economic history. In 1933, during the height of the Great Depression, the United States found itself at the crossroads. The dollar was firmly tethered on gold, with a fixed exchange rate of $20.67 per ounce. This exchange rate was a cornerstone of the country's monetary system. However, as Farber highlights, the financial crisis of 1933 saw a significant outflow of gold from the Federal Reserve. This outflow was driven by both domestic and foreign factors. On one hand, individuals and firms within the United States began to favor holding physical gold over bank deposits or paper currency due to increasing economic uncertainty. On the other hand, foreign investors feared a potential devaluation of the dollar, leading to gold flowing out of the country. To address the crisis, President Franklin Roosevelt declared a national banking holiday in March of 1933, a dramatic step taken to halt the drain on the Federal Reserve's gold reserves. This marked a turning point as the fixed dollar-gold exchange rate of $20.67 per ounce was disrupted. The subsequent shift from $21 to $35 exchange rate, as discussed by Farber, aimed to stabilize the economic system and restore confidence. This move, which occurred in the early 1930s, marked a departure from the historical gold standard that had been in place for decades. However, the consequences of this shift were profound. As Farber points out, the cost in money printing that ensued since 1933 has had a lasting impact on the US economy. In Rafi Farber's insightful discussion on the timeline of inflation, he highlights the evolution of economic conditions over the years. To begin, Farber draws from personal observations, noting that inflation was not a significant concern during the 1990s. This era was characterized by relative economic stability, and many people experienced a high standard of living with savings and upward mobility. However, as we move into the mid-2000s, there was a noticeable shift in the economic landscape. This marked the second point in Farber's timeline where people began going into debt to purchase homes. The third point in this timeline centers on the current debt levels and the looming crisis. Farber emphasizes the alarming situation where many individuals and households find themselves deeply entrenched in debt. Lastly, Farber explores the potential triggers of a financial crisis. He highlights the fragility of the current economic system with deep-seated issues beneath the surface that could lead to a crisis. In Rafi Farber's insightful analysis, he discusses the notion of an orderly decline in the dollar's purchasing power. This concept suggests that rather than experiencing a sudden and catastrophic collapse, the dollar's value could gradually erode over time. Farber points out that this decline would lead to a situation where everyday goods and services become progressively more expensive. Rafi Farber's analysis stresses the fact that the current economic system, characterized by constant money printing and increasing levels of debt, is fundamentally unsustainable. He draws attention to the accumulation of debt as a key issue. Drawing parallels to historical hyperinflation events like the Weimar Republic, Farber highlights the potential for rapid and extreme devaluation of a currency. While such historical events had to be contended with limitations in terms of physical currency distribution, today's technological environment offers instantaneous digital transactions. In Rafi Farber's analysis, he emphasizes the pivotal role of gold as a base currency. Historically, gold has served as a universal store of value and a medium of exchange. Farber explains that when we exchange money or a currency for goods and services, we are essentially engaging in an indirect exchange of gold. One of the key points Farber emphasizes is the close tie between the value of the US dollar and its historical convertibility to gold. For much of the 20th century, the US dollar was directly linked to a fixed gold exchange rate, providing confidence and stability in the currency. This convertibility meant that every dollar in circulation was theoretically backed by an equivalent amount of gold held in reserve. Farber's analysis also touches upon a compelling calculation based on the Federal Reserve's balance sheet and its gold reserves. He suggests that the dollar's value today is, to some extent, determined by its potential convertibility to gold. If a substantial number of people were to demand gold in exchange for their dollars, it could lead to a significant surge in the price of gold. Such a scenario could result in gold reaching an astonishing $30,000 per ounce. The potential consequences of such a development are staggering, including economic disruptions, loss of faith in fiat currencies, and profound shifts in the global financial landscape. Rafi Farber discusses a critical aspect of the danger associated with a rapid dollar decline: its exponential nature. Farber highlights that the fact that once the confidence in the dollar's value starts eroding, it can lead to a cascade effect. This exponential decline can have severe consequences for individuals and economies. In his analysis, Farber paints a scenario where people, recognizing the deteriorating value of the dollar, rush to exchange their dollars for gold. This scenario is particularly worrisome because it could exacerbate the dollar's decline. As more people seek to convert their dollars into gold, the demand for gold could surge, driving up its price significantly. In Rafi Farber's enlightening analysis, he stresses the importance of understanding the true nature of money, a fundamental concept that has far-reaching implications of our economic systems. Farber contends that grasping the essence of money is crucial for individuals in navigating an increasingly complex financial landscape. Money, he explains, is not just a medium of exchange or a store of value. It's deeply tied to gold. Farber further explains the intrinsic link between money and gold. Historically, money originated from the practical need for people to trade goods and services. Gold and silver emerge as the preferred mediums of exchange due to their intrinsic value, durability, and scarcity. Understanding this historical foundation is key to comprehending the role of gold in shaping the value of money. Farber contends that even today, when we exchange money for goods or services, we are effectively engaging in transactions with gold, albeit indirectly. In his analysis, Farber differentiates money from the other forms of value storage. He argues that while some may view gold as a mere shiny store of value, it's essential to recognize that gold is money itself. Money, whether in the form of physical currency or digital transactions, ultimately derives its value from the underlying gold reserves that support it. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well.